Well, hello there, ladies and gents, and welcome back to Path to Abundant Living. Ryan Ruff here, your moderator, but as always, I'll be joined by the guys at Morrison Nordmann Wealth Management. We've got Matt Nordmann on board with us today. Scott Morrison's taking the day off. But look, we've got another great episode dialed up for you guys today. We're living in an age where artificial intelligence has really taken over almost every aspect of different industries. And obviously, we take a close look at that with regard to wealth management and how it impacts your financial future. So we're going to take a kind of a dive into that world of AI and its intersection with wealth management. But we've got a wonderful guest that's going to be joining us today. We've got Adam Butler, who is the Chief Investment Officer over at Resolve Asset Management. And he brings over 2 decades worth of experience in investment management experience and really is keyed in on the greater side of AI in today's world. So really excited to dive into his conversation. But before we bring Adam on, let's go ahead and say hi to Matt. Matt, good to see you today. How you doing?
Ryan, great to see you. How are things? Happy New Year to you.
Yeah, happy New Year to you as well. It's good. It's cold. I could use some warmer weather. But no, holidays were good, and it's good to be back with you guys, of course. Matt, why don't you frame it up for our audience? You know, we have a lot of different guests on this show from so many different industries and walks of life. We've had some fun lately. I feel like we wanted to kind of pivot and get back to really wealth management, if you will, as we start the new year. But we're talking about this intersection of AI today. Tell me, what are you hearing from your clients about the questions, the concerns, the things about AI?
So Ryan, a lot of people want to know first, like, well, what is AI? I've had that question a number of times. Well, what, you hear about this and what is it and how will it or how is it affecting or impacting my life? Because that's most people want to know, that's all great, but how does it affect me? Right? That's the bottom line for most things in life. It's like, that's great information. Yeah, but. And so we thought, well, let's bring Adam on, right? He's been doing this for over 2 decades, like you said, and really um, deep into it when it comes to AI. And then how does that intersect with the investing world, right? Because you have qualitative versus quantitative, and you're like, and people are like, I don't even know what that is. And so when it comes to investing, and so you say, okay, well, let's bring someone in whose sole purpose is day to day to look at all this stuff and say, okay, how do we help our clients achieve what it is they're trying to achieve from the investing side with the AI and all these other things that are happening? Because as we talk about all the time, right, there's always political, social, and economic uncertainty in the world. And so how is AI going to affect that as well? Or how is it affecting it, right? We know, like, you get those videos that people send you and you're like, there's no way that's real, right? And so you're like, okay, but then on a bigger picture, how do you say, okay, well, how is this going to potentially affect me in positive and or negative ways? And say, okay, let's look at this not only currently, but into the next 5, 10, 20 years.
Right, right. And as folks will hear from Adam Butler today, this is an ever evolving situation. We're seeing new innovations with AI each and every day. So, look, hey, we won't tantalize our audience anymore. Let's go ahead and bring him on. Adam, great to see you, and thanks so much for joining us for the podcast today. We're excited to have you here.
Yeah, I really appreciate you guys thinking of me. I'm super happy to be here. Thanks.
Nice to meet you, Adam. Super excited to have you here. And
Yeah, thanks, Matt.
instead of jumping into the initial, we'll come back to it about how and why you got into the industry. But you've been doing this for, like Ryan said, for over 2 decades in the investment management world across, you know, different market cycles. And we all know, for those who are of the right age or who study, 2007, 8, 9, 10 were some interesting times. And how do you see the pre and post 2008, how it shaped risk today?
Yeah, I mean, so I entered the market in 1998, right, sort of leading up into the first major tech bubble in 99, 2000. And I started out as an equity trader on the equity trading floor at Scotia McLeod in Toronto, and watched that major run up into the 2000 bubble, made a bunch of mistakes, and learned some valuable lessons from that. In sort of from that point on till sort of 2008, I ran a more traditional wealth book, and I took the time to get my portfolio manager license, so I didn't have to run sort of that traditional business where you're calling clients and getting permission for every trade, and then your business orients around sort of generating commission. I always wanted to sort of orient around a fee model and migrate to the greatest extent possible into more like an asset management type business than a wealth management business. And over time, that's kind of how my career did evolve. But I spent a lot of time oriented around, very traditional investment techniques. So, trying to choose companies based on the type of analysis that you learn in the CFA program or in the Kaya program, discounted cash flow analyses, forming portfolios using fairly simple optimization methods, and otherwise employing a fairly discretionary approach, my own judgment, whatever I could digest in terms of information from the bombardment of information you get from interacting with markets from day to day. And so I ended up getting down this kind of rabbit hole in 2006, 7, 8 around a thesis that was promulgated by a guy named Don Cox. You're probably too young to know Don, but he was the chief global strategist at one of the big US investment banks. And he had this long-term commodity cycle emerging market thesis that I became very entrenched in. I learned all about. I knew everything there was to know about the depletion rates of the largest oil fields in Saudi Arabia and Iraq, and where potassium and nitrates and other fertilizers were located around the world, and which companies had bottleneck on those resources and all that kind of stuff. And came into the 2008 crisis feeling very prepared, thinking that the commodity super cycle would sort of withstand whatever was happening in the US banking system, and learned some more sort of valuable lessons. The big lessons were around just how impossible it is to understand all of the big dimensions of the story just by trying to use your own judgment and spend all your time reading and trying to understand markets. There's just way too much going on, and markets are way too complex for you to be able to understand that just by your own judgment alone. And that sort of led me off into a branch of investing called systematic investing or quantitative investing, where I learned how to best employ algorithms to identify the information in the markets with historically the greatest amount of reliability in terms of trying to inform what's going to happen next, and then use those rules systematically with increasingly sophisticated tools as we sort of climbed the learning curve on that, and we brought on more experts in that field to build our foundations. And so I went from more of a traditional kind of judgment-oriented practice to much more of a systematic and then eventually quite sophisticated, highly quantitative orientation, which eventually led to kind of machine learning. And that probably is a good segue into kind of AI and the evolution from machine learning to AI, what the difference is, and that sort of thing, if that's a direction that you might want to explore.
Yeah. So first, you must have been talking to Ryan when you said you're probably too young to know.
Well, some of us age better than others. I mean, what can I say?
Which again, so again, what I heard, correct me if I'm wrong, is you went from initially a little more of the qualitative, like you did have quantitative, you were using data, but then like you said, you're like, okay, how am I personally interpreting it? Maybe there are some biases that leaked in knowingly or unknowingly, and you said, wait a minute, okay, hey, let's go deeper in this rabbit hole over here into the quantitative, the actual data. And I'm sure you look back and go, man, I didn't know I needed to know so much about potassium in the world, right?
Yeah, absolutely. It's this weird, but I think universal quality of human nature that the more time you invest in something, the more kind of married to the meaning of that thing, right? So I spent just an inordinate amount of obsessive time learning about all, the resource and emerging markets area. And therefore I found I was so married to it that I was blind to what could go wrong, or I had overstated the importance of the things that I was focused on relative to the things that I was not focused on. And so just sort of the meta criticism that came after that, what went wrong with the way that I was thinking about the world and approaching the problem, and how can I take steps to short circuit some of those natural pathways going forward. And rules-based systems ended up being just a really good way to kind of short circuit those natural inclinations to get rabbit holed in potentially unproductive or too narrow frames on the world.
Yeah, because you can see so many people, this is good, bad, or indifferent, people who love the modern portfolio theory are like, it is the way and the only way. Again, and then you have humans who are making decisions, right? And it doesn't matter. And that's where, I like the idea of, hey, we have all the data in which is taken in, and especially with AI, which, I'm sure you're going to get into, there is so much information that's out there. Like you said, you can get down this rabbit hole and then you can say, okay, this is the way or this is the thing, instead of saying, okay, hey, the data is saying this. Is that a fair way to say it? Like, hey, no,
Yeah,
let's go back to the actual data.
yeah. I mean, the funny thing is that even as you go deeper and deeper into rules-based and quantitative methods, you can never avoid the human judgment element of it. Eventually you sort of need to decide what trade-offs you want to make, right? So even if you had perfect information, you still need to make some kind of judgment about what clients are going to prefer. So let's say that I could create a very efficient strategy. It delivers very reliable returns year after year, but it has a very high tracking error to the benchmarks that clients are focused on, right? So, we started out down that path where we were trying to just build maximally efficient portfolios and ignore the sort of tracking error preferences. And that ended up being really painful for us as a lesson because, we'd go through situations where we would do 6 or 7% in a year, which was right on target with what we had kind of coached clients to expect. But when the markets are in a major bull trend, often they're compounding at 15, 20, 25% a year, right? And you don't realize the risk until later, right? But during that period, we do 8, which is what we had tried to coach clients to expect. The market does 20. We do 8, market does 25. We do 8, market does 15. Every year, finally, you're not celebrating the 8s. Instead, you're defending the why you didn't do the 20 or the 25s, right? And it could be, and often was the case, that clients got fed up with what they perceived as sort of excuses and just moved on in time for the risk to manifest on the benchmark that they were actually focused on. And they were never able to actually benefit from the steady, efficient portfolios that we try to deploy on their behalf. So there's discretion and judgment and lessons about humanity and the interaction between human preferences and machines that it's like they say, it's turtles, right? Like there's no getting around the humanity of the decision making and how humans are interacting with those machine decisions. That's just kind of the nature of the game.
Yeah. Oh no, it's the way you're describing it is the emotion, right? Two things run the world, fear and greed. And we're very fearful until we look over there and like, well, they made 25. Okay. I know we talked with Adam about it. I'm okay with it. And then 20 and you're like, well, and then 15 and you're like, ow, right? And until that time comes when, oh, the fear kicks back in again and they're like, right. Oh, anyway. So yeah, it's very interesting, the emotional side, which you've seen for 2+ decades, of how
Absolutely.
that plays into this whole thing. So it's fascinating when you deal
Yeah.
with people.
Yeah.
So so what are the biggest misconceptions people have about these quantitative models or quant models, when if people hear that term, that's how it's shortened, especially during times of it's hey, when markets are going up, everybody says, hey, a monkey can throw a dart at the wall and win. So what are those biggest misconceptions that people have during those market stress times?
Yeah, I mean, one of the hardest things about quant is that it forces you to have a very deep grasp of risk and a very deep understanding of history, because the way that you build and test the resilience of quant models is you go back and use, as data as far back as possible to test your model frameworks against the widest variety of potential market and economic conditions, right? Whereas the normal course of human life is that you really are only able to internalize lessons from your own experience. My my father gave me all kinds of wisdom when I was growing up about, productive activities, productive ways to be, things to avoid, risks that were out there that, of course, I didn't listen to because I thought that I was, I those did not crystallize for me. They had no emotional salience. I hadn't experienced the consequences of ignoring that wisdom, right? And that's just the natural human journey, right? So if we don't have a bear market for 10 years, then people really begin to forget about risk. And also there's just an increasing variety of people that are just newly entering the market that have actually never experienced the risk in the market, and they've only ever experienced the rewards, right? And so just trying to communicate the things that quants focus on obsessively and religiously, they tend to be stuff like statistical significance, resilience in different economic environments, risk management, right? These are the dimensions that quants pay attention to that clients could care less about most of the time, until, of course, the risk manifests, and then, half the time you get to say, okay, well, this is why we spend so much time trying to teach and coach about the importance of risk management and resilience, right? But then the other half of the time is just kind of random events that no, quantitative model could possibly anticipate. When a plane flies into the building, there's no historical template for how markets respond to that. There's no parties that have insight or information about the fact that this is going to happen in advance, where they would be then, making decisions in markets, where markets would then be moving in directions that would give our model signals that something might be up, right? These pure exogenous risk factors, doesn't matter how good your model is, if you happen to be positioned in a lucky way going into that, when the asteroid strikes, you look smart. If not, you look dumb. If it's an endogenous event, in other words, if internal market forces are the things that are generally resulting in a change in regime or a major change in market posture or market trend, then the data-driven models can do a very good job of identifying that probably far in advance of when the stories that are driving this emergence of risk are coming into the Overton window, and people are starting to recognize that there's something here. We always say that the narrative follows the price, right? The price trend changes. You don't really know why. The systematic guys, the models pick up on it, but they're not really interested in the why. It's the why comes a little bit later. That's a page 16 story that moves to page 5, that moves to page 2, and eventually to page 1, when now it's sort of in the broad public knowledge. But most of the damage has already kind of been done most of the time by that point, right? So it's just kind of like recognizing that the quant models are often going to be out of sync with what clients expect based on what they read and understand about the current worldview and the current environment. That ends up being the point of maximum dissonance most of the time, right? And then when things go wrong, if they go wrong for exogenous reasons, like the asteroid strike, then they're kind of grumpy because, well, I thought you had risk management in place, and it's not immediately intuitive, right? That, well, yeah, no amount of risk management really could have hedged against this. or the types of risk management that could hedge against this have other penalties you wouldn't want to pay all the time, because most of the time the asteroid's not striking, right? So you don't always just want to be rolling puts in the portfolio in anticipation of the asteroid striking, because you've got this major negative carry, right? So there's all these trade-offs that are hard to grasp, and if you're not immersed in this all the time and paid to be, then I understand why people are not going to grasp it.
So it makes perfect sense when you're in it all day, every day, and helping to educate people on like exactly what you were saying. It's like, hey, the models are the models, and we have as much data. No one predicted this. And so now if we can plan for 95%. It's that 5% that we can plan for that. But like you said, there's going to be a drag, and there's going to be, drag on the portfolio, or you're going to put have a bunch of puts in there to offset it, which then is going to drag. If you want to have that, all the risk taken off, well, then there's other risks that you're taking on when you do that. So yeah,
Exactly. That's a really good point. Yep.
It's really interesting. And you were talking about having new investors coming into the world of investing, or those who haven't gone through. Like I remember 2007, 8, 9. I remember Art Cashin, if you remember Art.
Of course I do.
That guy was on CNBC almost every single day, because he'd been doing it for 40 plus years at that point. And one of his favorite phrases that I heard on more than one occasion, anytime there was any kind of a positive turn, he's like, well, you just got to make sure it's not a dead cat bounce. Because even a dead cat will bounce if you drop it from high enough.
That's right. That's
Okay.
right. We love that.
For those who love cats, no offense, but it was just really interesting. But he was on every day, again, trying to, educate people of, this is a thing, and we're going to adjust. And I know that's what you all do as well. So, we have had periods of, and I go back to 1954, I want to say. My father-in-law, he just turned 89. He has, in his garage, he has framed, and if people watch this, they can see it's his first paycheck, and he made $1 an hour, and he worked overtime, and he made $52 for the week, and he could live on $52.
Right.
Well, you can't live on $52 for half a day right now. And so, we have more inflationary than deflationary times that we've gone through. And so how is it that you can create portfolios that can survive both inflation and deflation?
Yeah, great question, right? So most portfolios are constituted from stocks and bonds. If you're really bright, you're using diversified stocks and diversified bonds, right? And if you think about the world of markets, they're generally driven by two different types of forces. One is changes in expectations about growth. The other is changes in expectations about inflation, right? So if you think about what drives markets from those two dimensions, you've got 4 quadrants, right? You've got high growth, high inflation, low growth, high inflation, high growth, low inflation, low growth, low inflation, right? And so think about mechanically how the stocks and bonds work. Well, stocks do well, or stocks do better than expected when growth is higher than expected, right? When you've got this sort of positive growth shock, right? They do worse than expected when growth is worse than expected. And if growth is a lot worse than expected, that's compounded by the fact that typically equities are short bonds, because typically they have leverage, right? And when growth slows, you get closer and closer to the point where the profitability of the company is insufficient to cover the interest payments on the bonds, which are that's kind of where things get really problematic, right? When, the markets are designed for the equity holders to take the risk, and the bond holders to take almost none of the risk, right? In return, the equity holders get all the upside and the bond holders get none of the upside, right? But when growth is threatening to roll over to the extent when corporate profits are insufficient to cover interest payments. Then the bondholders get very concerned, and you also get this cascading crisis in the bond markets, right? So in that way, corporate bonds at least are very similar to corporate equities. They're both responding to the same type of growth risk, just at different times in the growth cycle, right? Now, treasury bonds are a little bit different, right? When do treasury bonds do well? Well, typically when growth is slowing at a faster pace than expected, because that's typically accompanied with price deflation. You've got lower demand than you have supply. Inflation is declining, and so bond yields are falling. So the price of bonds is rising. So you've got rising bond prices. You've got falling equity prices in this negative growth shock, but they're kind of moving in opposite directions for the same reason, right? So from that perspective, they're kind of nice diversifiers. But one of the big problems is that the stock sleeve in the portfolio, even if you've got 50-50 stocks and bonds, stocks are so much more volatile and move so much further in percentage terms on bad news than bonds move upwards on bad news, that with 50-50 allocation, the bond allocation can't possibly offset or properly diversify what's happening on the equity side, right? So one component of resilience is balance. If you've got things in your portfolio that behave in a diversifying manner, so you expect one to go up while the other one is going down, you want to own them in proportion so that they can balance each other off, right? When bonds go up, they can balance off the effects of stocks going down. And typically what that means, if you want balance in a pure stock bond portfolio, is you want to own a lot more bonds than stocks. If you do that, now you've got a balanced portfolio of stocks and bonds. But one problem is that both stocks and bonds respond negatively to an uptick in inflation expectations, okay? Bonds can protect against a downtick in inflation expectations, but not an uptick. And stocks also do poorly. They do okay in like stable positive inflation, but the evidence shows that once inflation ticks above about 4% annualized, stocks also are negatively impacted by inflation. So then the question is, well, what do you have in the portfolio that does well when you have sustained inflation, if both your bonds and your equities are in jeopardy? And that's where we start to get into some alternatives. One alternative is Treasury inflation protected securities, right? TIPS. They defend against a certain type of inflation. Gold defends against a very different type of inflation, the inflation that comes from mostly a collapse in faith around the desire of governments and government institutions to defend the value of a currency, right? In which case, the value of the currency typically falls, and because the supply of gold is fixed, mostly fixed, that ends up being a nice hedge. Commodities also can be a really great hedge against inflation. Think about the 1970s when there were blockades on crude oil deliveries out of the Middle East. Massive spike in oil caused a major inflation spike. Both equities and bonds dipped on that. And obviously commodities did extremely well, compounded above 10% a year for the entire decade of the 1970s, right? So we like to think about resiliency as kind of a combination of two things. One is balance. So you've got different components in the portfolio, but they have very different risk profiles, and we want to try to balance them a little bit better. But also diversity. You want to hold a wider variety of assets in the portfolio that are functionally and mechanically designed to thrive under very different economic drivers, right? Either demand side inflation, TIPS, just the economy running too hot. Supply side inflation, commodities, right? You've got a major embargo on oil. or monetary inflation gold, right? So the idea is have all of these different drivers of returns in the portfolio and have them in proper balance. And then, of course, there are other sort of active strategies and other more sophisticated things that you can layer on top, but that's the general concept.
Yeah, and then, like you said, having all these different aspects of the portfolio all diversified, and then educating people on, yes, what you see on TV, that S&P 500 that's up, yeah, you have a sliver of that. It's not your entirety, because you remember that thing that occurred, and when the markets dropped 33% in 3 weeks in March and April of 2020, do you remember that? Which I don't know if you've had this discussion with people. I've
Oh,
asked
yeah.
almost 20 people. If you ask them, I've asked a lot of people this, I'm just a running tally in my head. It's about 20 people. Well, you remember what happened in 22? And they're like, no, well, the markets were down, bond and stock. Oh yeah. Well, you remember what happened in 2020, right? And one person, so 5% in my small sample size, one person, well, you mean COVID, right? Nobody else could remember that the markets tanked, right?
Yeah.
Right, for that period of time. And so it's that we all have we the general, we have that short-term memory. And so to your point from way back earlier of people who are new to it haven't really experienced 2022, which was a very telling year for a lot of people, to remind them this is normal.
Yeah.
Volatility is normal. 5%, 10%, 15% drawdown in any calendar year is normal. And so yeah, it's fascinating, and yet we still continue to do this work, right?
Absolutely. Yeah. I mean, it's the good news is that um, the the rules have changed and the tool set has expanded, right? So we have more tools now at our disposal to better manage those two primary dimensions of risk, right? The risk of absolute loss or loss of purchasing power in the case of inflation, right? And the tracking error risk that the clients are concerned about, right? And so, that's why after way too long trying to fight the tide, we finally just capitulated and said, okay, we get it. You don't actually care about absolute returns. You've got your own benchmark that you care about. Yeah, you want to maximize risk. Yeah, or maximize return. Yeah, you care about downside risk, but you've got a certain set of preferences, and we need to provide tools that strike the right balance between resiliency and tracking error orientation.
Adam, you're talking about finding the balance and then kind of going against the tide a little bit. It's kind of a natural segue into one of the questions we wanted to hit today. When we're talking about portfolio construction, what seems to be one idea these days that even sophisticated investors out there are just still consistently getting wrong over time?
Yeah. I mean, we still, it's and I keep going back to the fact that we didn't really put wheels on suitcases until the late 1980s, right? So, I have a lot of sympathy for the fact that it's, not everybody lives and breathes this, and things discover things at different times. But the single greatest opportunity, I think, still for investors of all classes, sure, like the Canadian pensions and the big sovereign wealth funds and some of the biggest institutions in the US around the world cottoned onto this a while ago. But this idea that your investment portfolio represents vastly more potential than the 100% allocation you have to the cash funded investments that you have in your portfolio, right? So you've got a portfolio that's 60-40, about 60%, let's just keep it super simple, 60% in a US equity ETF or global equity ETF, 40% in a Bloomberg Ag ETF or something similar, right? Well, that's great, but there's an enormous amount of opportunity that portfolio unlocks that you're not taking advantage of. And it's just the idea of capital efficiency, right? If you stop thinking about your cash funded portfolio as all there is, but rather as a certain a set of assets that collateralize a broad portfolio it completely transforms your point of view, right? So for example, you can take this 60/40 portfolio, you can have this on deposit at a broker, and you can use that to collateralize a wide variety of other trading on top of that portfolio, right? So, one of the absolute best diversifying strategies with by far the longest track record going back well into the early 1970s is this idea of managed futures trend following, right? You don't need to sell any of your stocks and bonds. So the traditional equation is, I want to add diversifiers to the portfolio, right? I've got stocks and bonds. Let's say I want to buy a trend. I want to get allocation to trend because I know it's a great diversifier. So typically you say, okay, well, how much of my stock bond portfolio do I want to sell down in order to buy a managed futures fund, right? Okay, well, I guess I'll sell down 10% or 15%. And then I go and I'm going to find this managed futures fund and I'm going to allocate to that. And I'm going to every year I'm going to talk to my investors about how great this diversifier is. But you've got this line item on the balance sheet that's doing what we already identified that investors hate. It's taking away from exposure to the asset classes that they know and love. It's giving exposure to an asset class that they understand less, that the benchmark is now published in the Wall Street Journal every day for them to track, and that behaves wildly differently than everything else in the portfolio. And the advisor ends up having to explain every year why this diversifier, or many years, why this diversifier is underperforming their stock bond portfolio, and defend why they carved off some of that portfolio they know and love to give access to this, right? Complete change of thinking, okay? Keep your stocks and bonds in exactly the proportion that you want, and instead think about that portfolio as assets that can collateralize the trading of other assets on top, right? So you may be familiar with, just a simple example, familiar with some of these ETFs that give you a 100% exposure to stocks and a 100% exposure to bonds stacked on top, or some similar combination, right? There's a few firms out there that provide these types of ETFs, right? So let's say you've got a 50/50 fully invested stock bond portfolio. Well, you can sell fully half that portfolio and invest half of the portfolio only in this 50/50 stock bond portfolio and get exactly the same return as you got by investing the full portfolio in the fully cash funded version of the ETFs, right? And that allows you to, now you can slide on or alongside any diversifier you want. If you like private equity, slide that on. You want high yield bonds, slide that on. Private equity, merger arbitrage, you name it, you can fill up the other half of the sleeve or the other half of the portfolio with these diversifiers, but crucially without forcing the client to sacrifice the return stream from the sources of return that they know and love best, right? And so this is why we sort of shifted from this idea of, well, no, you should just stop it. Stop being human. Stop. You actually do want this perfectly efficient portfolio, and you're just going to suffer through it with me, right? Instead, it's like, no, okay. You want this stock and bond exposure. You got it, right? How about we just use your portfolio collateral more efficiently to stack these other return drivers on top, so you can have your cake and also eat it too.
Yeah, I love it. When you look at these rules-based approaches, some would call them unemotional by design,
Mhm.
right? So what's the hardest part for investors to understand and to stick to these rules-based designs?
Yeah, I mean, often it's just the lack of intuition, right? Like, it's one thing to sit down with a client, even sit down with a client once a quarter and sort of review the underlying assumptions, the historical data that support those assumptions, and the oftentimes it's kind of like knowledge and intuition behind those assumptions. Demonstrate how portfolios constructed in this way have performed for many, many decades through a wide variety of different regimes, but then have to constantly face that, underperformance when the markets are in their sort of multi-year bull phase. And it's the dinner party conversations. They're going to dinner parties. Hey, I bought this great stock. It's in the sector that everyone's talking about, and I'm convinced it's going to the moon. I'm already up 100% on it. And instead, you're sitting there with this well-balanced, resilient portfolio, but there's nothing interesting to talk about. Despite the fact that, your advisor's gone through it with you once a quarter for the last 6 years, you still really haven't internalized how it works and why. You don't know how to explain it well. And plus, you've underperformed the market for the last 5 years because we happen to be in a bull phase, right? So you don't even have this kind of like proof of concept behind you that you can use to back up your views in those conversations. And it's not just conversations at dinner parties. It's typically in a household, one of the spouses is responsible for managing the portfolio, and the other spouse mostly doesn't pay attention until very specific times in the cycle. When? Well, after the market's been doing really, really well for a while, all of a sudden the spouse that hasn't been interested sees it right in front of their face every day on like the regular news and starts asking questions. Hey, are we invested in AI, or are we invested in this big data center build out? Or, I guess we must be doing really well in the portfolio right now, right? And then the other spouse is like, well, no, we decided to invest in this prudent, resilient, long-term, blah, 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 right? So, and then of course, during bear markets, the exact opposite conversation happens. Oh my God, markets are collapsing, what's happening? And then at least the other spouse says, well, actually, this is the rainy day that we kind of built this portfolio around, right? So there's just all these different sources of emotional dissonance from a lack of understanding and from this, just tracking your regret. That's kind of just an inevitable part of human nature.
It comes back to what I'm hearing again is educating people as much as they want to be educated on it. And like you said, if it's quarterly or whatever, just reminding them, hey, have you changed what you're trying to do or achieve? And if so, then hey, then maybe we need to change the portfolio. But if not, this is doing exactly what it was set up to do.
Yeah. I mean, Josh Brown said it great, I think, several years ago. I don't know if you know Josh, but he said, if you tell a client no once, in other words, client comes to you and says, I don't like this allocation, right? We're underperforming. We've underperformed this year. I don't like it. And you say, I get it, but we talked about this. It's in there for a reason. I expect it to pay off eventually at the right time, blah, blah, blah. Year 2, same conversation. Year 3, when the client comes to you and says, I really don't like this. This is the 3rd year we've underperformed. I told you twice before. If you don't say, okay, I hear you. I hear you where you're coming from. And if you don't accommodate, at least to some extent, their wishes and preferences, then the client's inevitably going to walk out the door, right? And so there's always this balance you need to strike between your own knowledge base, the research that you've internalized, and where the client is in their own journey of understanding and their own set of preferences and et cetera, and who they need to explain their decisions to and their preferences, et cetera, right? There's like a cascading waterfall of accountability that we don't see when we talk directly to the person who is, directly managing the portfolio, right? And so I just think, and we also need to be humble about the mistakes that we can make and acknowledge that clients have good points lots of the time and take those into account.
Yeah, you're right. And that's why it's a collaborative approach, right? It's not if you're looking for an order taker, well, there's plenty of places that will take your order. But if you're looking for decades, right, of experience and and how we can, help you achieve what you want to achieve, then hey, this would be a good fit. So,
Exactly.
so artificial intelligence, AI, is advancing rapidly,
Hmm.
right? And it's already affecting markets and economies around the world. How do you see AI changing that quantitative investing in the next 1 to 5, 10 years, and how people should be paying attention to it?
Yeah. So this is such a open-ended question. There's a number of directions to go. One thing I did want to highlight kind of before I got into um, more of the how AI affects quant is that AI will also, I think, affect qualitative investment research as well, right? For example, one of the things that I do all the time now is I identify some sort of phenomenon. Maybe it's a rule change, maybe it's a major policy change, maybe it's an emerging technology, and I ask the AI to generate a comprehensive research report uh, on what's happening, right? So now I get familiar generally with this new theme, but then also I ask it to generate a report on the companies that are from a second and third order effect impacted by by this change in or emergent trend, right? So, for example, um, as this whole data center thing was heating up and all the sort of first order stocks were really rallying, right? The Nvidias and the Metas and the Microsoft, et cetera, were all doing very well. Um, I went in and generated a report like this and identified the fact that there are bottlenecks at the electric grid level, and in some cases at the materials level, that make it impossible for us to scale the um, the data centers to nearly the extent that is hoped for, right? Um, and therefore, there's this sort of this narrow list of companies that are, if we're going to achieve the data center objectives, which the major companies are pricing in, okay, then certain things need to happen, which is going to drive the earnings for this other set of companies up by several orders of magnitude, right? And that has not yet been noticed because, yeah, the market is a bit of a discounting machine, but it's amazing how I would typically classify the market as kind of a 1.5 order thinker, right? It's never thinking kind of 2 steps ahead. It's sort of thinking about the right now and maybe half a step ahead, right? So if you can think 2 steps ahead, you're getting just ahead of the trend that's coming, right? So just an anecdote of how AI can be utilized qualitatively for investment as well. On the quant side, it does a few things. First of all, it helps to surface new data sources that maybe you hadn't yet thought of. This could be directly related to AI, like using the semantic content of news or things like that to to build into your models as features that inform positioning, right? But it can also just be using the knowledge base of AI to identify, that wow, there's this whole data repository of pipeline data, European natural gas pipeline data that may help inform how oil is priced or changes in oil prices over time. Or, you can just imagine just like an enormous unlock of just dimensions of information that you're just not aware of, but that could add tremendously to your process, right? So just sort of amplifying your ability to do research and surface ideas, that sort of thing. Also are able to explore new hypotheses. Like most quantitative investing is kind of a scientific endeavor, right? And as such, what you end up doing is just you have hypotheses that derive from the way that you think worlds work or markets operate. And prior to AI, used to take a team to go and gather the data and then code up the simulations and run the hypothesis tests, et cetera. And now the AI can accelerate that dramatically. The AI now can, if you've got the data that it needs readily available, you can typically feed an AI, a white paper into the advanced AIs, and it will replicate the process in the white paper that generated those results, right? Whereas so as a quant manager, we used to release white papers willy-nilly because we had no real worry that there just weren't that many people that were going to go out there and try to replicate our strategy rather than becoming clients, right? The other firms that are doing what we do, yeah, they can replicate it, but they're probably already using some of these techniques, and B, they'll never be a client, right? Now, if I publish a white paper, a client can go replicate it and run it on their own, right? So it changes how you kind of market and talk about your strategies a little bit. And then at the far end, you've got the introduction of new architectures of models, right? So the transformer model, which is what language models run on, which is what we now sort of typically call AI. Well, those transformer models can also be used for, directly for quant strategies, taking your exact same kind of features that you were using for less sophisticated models before, and you can then just transform those in ways that allow you to use the transformer models to extract even more information potentially from that same data that you were using and deliver better performance, right? So as new architectures are presented and utilized in different domains, so yeah, Citadel's not going to publish the fact that they created a new machine learning architecture, right? Because that's proprietary to them. But DeepSeek publishes, the Chinese AI company that grew out of a quant investment firm, publishes all kinds of new model architectures because they're behind this open source AI phenomenon, right? And so you've got all these other journals that are constantly publishing new architectures for learning models that are not in the quantitative finance journals, but that are directly mappable onto quantitative finance use cases, right? So that opens up an enormous amount of opportunity. So you can see there's just, I'm only really scratching the surface, but that's kind of 5 different dimensions over which AI can already have a very large impact.
And I think, which, like you said, you're scratching the surface. We are at the beginning or the cusp of my kids are 26 and 22, and I remember they would talk with my dad when he was alive and then their other grandpa about the first television set that they ever got. And I know you're of the age, I'm guessing, or you can go, what's the first computer that you had? And it was C: prompt, right? And way back in the day. And it's like,
Yep.
You have the power we all have the power in our hand, the computing power. It's just, and to think 5 and 10 and 15, 20 years down the road as to where we're going to be is very exciting. A little scary, right? There is some growing concern
Sure.
for artificial intelligence, and it could, really potentially, we'll say, wreak havoc when people are a little concerned, right, with economies and political systems. And so from an investor's perspective, how do you model risks that there is no historical precedent? Like we were talking about, there's no historical precedent about the asteroid, right? So
Yeah.
there's no historical precedent in this situation. So how do you model those?
Yeah, I mean, the good news is that you've got just an enormous number of actors who are acting on markets, expressing their guess about how the AI phenomenon is going to evolve, right? There are going to be some actors who are maybe hypothesizing that if automation and AI take off very quickly, that it'll be such a shock to the labor system that we will have much higher than normal unemployment. And that sounds great at first glance, but then you think about, well, you're also losing an enormous amount of consumption, right? Like when you're unemployed, your consumption declines pretty dramatically, right? Well, yeah, the top 10% currently account for over 80% of discretionary consumption and just shy of 50% of total consumption. But the other 50% of total consumption is, people who are working for a living. And if they are no longer working for a living, then they're cutting down on grocery spend, they're cutting down on buying TVs, cutting down on cars and the miles traveled and all that cascading stuff, right? So, there's a segment that are trying to price the risk of that kind of scenario. That there's other segments with an expertise on, maybe very close to the metal in terms of what frontier models are capable of today and what they're likely to be capable of in 6 months or a year, and are in the markets, making bets, making investments, allocating resources in order to capitalize on that or hedge against the risks that might arise from that. And the great thing is all of those forces show up in price, right? Which is why, systematic managers, for the most part, rely mostly on price, because by the time there's always actors that kind of have insight that are not captured by any of the official statistics, no matter how kind of deeply you go, right? But they have enough knowledge to act on the system, but that they can't act on the system without changing it. And so the benefit of the quantitative models where you're trying to look in all directions at once, is that those footprints are captured and acknowledged and inform how the models are positioning portfolios, right? I think it's very difficult from a discretionary standpoint, no matter how close you are to a lot of these different things. It kind of goes back to, I was an expert in emerging markets and commodities, but I got too narrowly focused on that one vector of change, right? Whereas if you allow the market to speak and you look at the market from a sufficient variety of dimensions, you're more likely to see those footsteps and be able to act at least partially in alignment with them.
Yeah. Well, appreciate your time. I could talk for a lot longer, ask you a lot more questions about this stuff because this is fascinating and really, like you said, scratch the surface in a lot of different areas. I'd love to, dig deeper, but I know we've taken up a lot of your time, so really, really appreciate you being here. And I know that a lot of people are going to really appreciate your insight and expertise in this area.
Well, thanks so much for all the great questions. I really enjoyed it, talking about things that I am passionate about, and I love to talk about. So thanks again for having me on.
Yeah, that hour went by really fast. Like I said, I could ask you, I could keep you around for a lot longer, but want to respect your time. So.
Another time.
Yeah.
All right, well, folks, there you have it. Adam Butler, Chief Investment Officer over at Resolve Asset Management. Geez, just a load of phenomenal information with regards to portfolio structure, asset allocation, risk management, the birth of AI. I mean, just so much to dive into. Matt, I mean, it's a loaded question just asking you what the key takeaways were, but what were some of the chewable moments for you?
There has been and for 100+ years, there is a transformation that occurs when it comes to investing and how we see things. And having someone like Adam or a team like that is not so quote unquote stuck in their ways, right? You need someone who is open to continually learning about what's going on and not saying, well, this way is the only way, right? But it's okay, we're going to take these models and we're going to look at them and we're going to continue to look at them and continue to look at them because there's so much more information that just continues to come out. And so we could talk, like you said, you could dig deep into all this, like he did, right into potassium, right into all these different things. You're like, wow, who knew? But it's like having someone like Adam or that team or someone on your side of the table that's really saying, okay, what are you trying to do, Ryan, for you and your family? And then how do we take that and say, okay, if we're going to go this, as some call them, those unemotional rules-based models, yeah, that's potentially what it might be. But if that's going to get you to where you want to go, why wouldn't you do that? And trying to take as much emotion out of it, but money is very, very emotional. And so how do you take that out? Well, learn as much as you want to, but you don't need to become an expert because you have Adam as the expert.
Right, right. Exactly. A big thing that I recognized is that, gosh, portfolio structure and asset allocation, Matt, I know you know this. It's not everybody's cup of tea. They're not, that's why they hire teams like Adam's and like yours to walk them through and help them achieve those financial goals. But boy, did Adam just do a great job of breaking down what seems like this monumental thing in those topics and delivering it in a educated and kind of white collar conversation, but at the same time, I don't want to say dumbed down, but broken down into some methodical mannerisms and examples and analogies. But then to take that a step further, what I found to just almost like I'm over here chuckling to myself as the conversation's going on, just thinking that despite all the advances in quant models, AI and the impact that not only it's going to have on the markets themselves, but the way we invest and structure our portfolios, at the end of the day, there's still the human element. And we talk so much about that on the show that money is emotional. It is something that we cannot keep ourselves from being emotionally invested in and want to be able to see our money do great things for our lives. So it's funny that despite all of these advances and all these new tools that we have to make such calculated decisions, it always comes back to us, and we're the ones that are in the driver's seat that could ultimately end up making the wrong decision despite having all these great tools.
Yeah, we all want to make smart decisions with our money. I mean, yes, in all areas of our life, in addition to making smart decisions with our money, right? Nobody wants to look back and go, "Man, I wish I would have." Right? It's going to be, "I'm so glad I did." And yes, we all make mistakes. And like he was saying, it's like, okay, maybe 1 or 2 years. It always comes back to when we talk with families is, what do you want to have happen? And is the plan we have in place on track to do that or behind, and do we need to make adjustments? And that's what it comes down to, right? We
Right.
can't say in 1 year, 2 year, 3 years, hey, maybe it's time to make adjustments, or can reconfirm that, yes, this is what we're trying to do and this will get us there. And
Right.
there's always, always, always so much noise that's out there. And nowadays, everybody has an opinion and everybody thinks that everybody else wants to know their opinion, which we
All
know
the time.
all the time, which is not necessarily the case. And when it comes to money, again, one of the most emotional things, yeah, it's again, we live in interesting times.
That we do. Well, you mentioned, I mean, despite the complexity of the conversation and the general thought processes behind asset, allocation and portfolio management, it starts with your goals. It starts with your life, your conversations on what you want to see happen. So, Matt, for anybody that wants to jump back to that starting point so that they can understand these processes, they can make those smart emotional decisions. Uh, what is the best way somebody could reach out, talk to you and your team, and start that conversation to get back to square one, talking about goals, and then lead these educated decisions moving forward?
There's two ways. The traditional way is make a phone call, 517-333-7967. Call, make an appointment for a get to know you call. Or go to our website, Morrison Nordmann, two N's on the end of my name.com. Click on the book a call, and we will spend a few minutes with you figuring out what it is that you are trying to achieve so we can point you in the right direction.
Fantastic. Well, Matt, as always, I appreciate getting to spend some time with you. Adam Butler is just a dynamite guest here on the show today. Matt, we'll see you back here on the next one. All right.
Great to see you, Ryan. Look forward to the next one.
You got it. Look, folks, we're going to take a final moment, as we always do, and thank you for making us a part of your day. If you enjoyed today's discussion, if you learned a thing or two, I know I did, make sure you hit that subscribe button on whichever platform you checked us out on today so that you don't miss out on any future conversations where Matt, Scott, myself, we bring on some great guests to bring value to you and put you on that path to abundant living. But again, for Matt and of course for Adam, I'm Ryan. We're going to go ahead and say so long, but we appreciate everybody stopping by and being with us today on Path to Abundant Living.